right now. We have William Lee, Chief Economist and Executive Director of Milken Institute, joining us from New York. Hi, very good morning, Lee, and thank you so much for your time. And first up, that's the fresh trade deal that has been announced. So why don't you help us understand more on that? Because of the investments that has been set coming in from to the US, as well as there has been a cut with respect to the tariffs from 20% earlier to 15% now. What does it really mean when it comes to this particular trade deal? And along with that, the chip counters, they are buzzing. So once again, a renewed interest over there. What are your thoughts on the same?
Well, I think the shape of President Trump's tariff agenda, and in fact, it's not a tariff agenda, it's an investment agenda. And we see it in action in this Taiwan deal. It's a long-awaited deal where the United States is essentially showing the world that if you invest in the United States, the way Taiwan Semiconductor has agreed to do, and if you invest in, as they have done, $250 billion into developing a new plant and expanding their existing plants, you will get exemptions from the higher tariff rates, and I think that's the source of much of the revenues that the U.S. has gotten over the last year in terms of trying to help its fiscal deficit. But as far as investors are concerned, I think it's made very clear that President Trump is very serious that if you want to avoid tariffs, if you want to sell in the U.S. market, come invest in the United States, because the United States is where the money and capital is most productive throughout the world. And Taiwan Semiconductor is a prime example of that. A successful company becoming even more successful.
Right, Mr. Lee. Also, we do see the tensions with Iran that were seen escalated, now de-escalating. Especially with that comments coming in from Trump that the insiders are informing that the killings have stopped, and therefore a softer stance by Donald Trump. And therefore, we did see that downtick coming in the oil prices as well. We did see a fall of almost 4% on the oil as well. How do you see this situation to pan out? Because there has been a lot of fluctuation as far as global oil market is concerned.
Well, Iran actually is a very small player in the world market right now, because let's remember, Iranian oil is sanctioned and you're not supposed to buy Iranian oil. And the people who are buying it, primarily China, are doing it in the black market. And I think with the easing of tensions, I think what we would expect further on is to see the supply of oil increase from Iran if the government of Iran becomes more legitimized and not the kind of government that is so against the West as it is now to be subject to sanctions. Once the sanctions are lifted from Iran, we would expect a massive increase in investments into Iran and a supply of oil coming out of Iran. So in the medium term, I would expect tensions easing to mean oil prices stabilizing or even going down. And that's the same event that we expect in Venezuela, where, again, massive investments are going to be going into restoring the productive capacity of a country so that the people of that country can benefit from its resource. So I think one of the things that we should see in the world right now is that the investment agenda put in by President Trump is trying to draw capital into the United States to try to invest there. And the foreign policy of the United States is to try to ease tensions in a way that promotes not only political stability, but economic stability as well.
Also help us understand where the money will find its way from now, because amidst all these geopolitical tensions and the statements there, it was not just a bit of a jump in the crude oil prices, well, of course, backed by the news flow, but even the safe haven demand was something that we have seen with respect to the gold as well as silver prices surging. And on the other hand, the US markets were also holding up well. But now that the tensions are easing, the Trump's policy are on its way, where do you think that the investors will find interest from now on?
I think the source of growth right now, as the United States has been demonstrating in the last year, is from productivity. And in the United States, we are expecting almost 5.5% growth going forward. And even though our labor market is weak, we're not really creating the number of jobs that we really need to create. But because of the investments we put in place the last 3 years, we're expecting that the productivity growth will continue to carry the day. And for investors, that's great news. That means that every worker that's working is more productive. You can actually pay them more, and your products can be sold for less, and your profit margins can be increased. This is the best of all worlds. Now there are some downsides to this, and I have to say, one of the social tensions in the United States is that the employment growth is not growing fast enough. Income growth isn't growing fast enough to allow workers who don't own capital, who don't own shares in the NVIDIAs in the high-tech world, those people are really living hand to mouth. This K-shaped economy is a social problem for the United States, because I think what we have to do is focus the investments in a way that makes workers more productive so that workers can be paid more. What my fear is that a lot of the technological progress and a lot of productivity changes will be making machines more productive, and companies will be investing more machines. And that would be a very bad thing for the United States, because there, the return of productivity will go to the owners of capital, which is the top 10% of the wealth holders in the United States. And that would cause even more political stress, which would show up in the midterm elections and maybe even the presidential elections going forward. And I think President Trump is well aware of that, and trying to, again, provide tax incentives and deregulatory incentives so that investments go toward making people more productive, not just machines more productive.
All right, Mr. Lee, on that note, thank you so much for joining us and weighing in on the global situation. We'll let you go on that note, and thank you so much for joining us today. But with